Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest, he's an Austrian school economist. He's also been professionally managing money since 1991. So he's been through a lot of bull markets, a lot of bear markets. I actually want to ask him about all the craziness with this bear market rally and the tech bubble. Seems like we have another tech bubble and the crazy rally that's been happening lately. Adrian Day, thank you for joining me.
Well, thank you very much for asking me. I appreciate it.
So, Adrian, we've just had absolute craziness with the volatility. We're recording this on Friday, February 10th, 2023 for our listeners out there. The last 2 or 3 weeks, it looks like a short covering rally, a bear market rally, a short squeeze. Does this remind you of what happened in 2001 with the tech bubble and how there was like a false rally? I remember seeing the Wall Street Journal headlines going around Twitter couple of weeks ago from 2001 about how these tech stocks with no good fundamentals rallied anyways. Is that kind of reminding you of what happened back during the tech bubble?
Yeah, in a way, but any mania, any extremely overvalued market tends to have this volatility at the end. And it comes from, as you say, it comes from short squeezes, and a lot of other factors. But that's sort of typical, I would say, for any mania, whether it's Japanese real estate or gold in 1980, for that matter, or tech in 2000. You have this sort of extreme volatility at the end.
But I think an important thing here compared to the past tech bubble is that the Fed has kept raising interest rates, and they raised interest rates in pretty quickly in a relatively short amount of time. Do you expect then that there's not going to be capital available because of these higher interest rates, and that we're going to start to see bankruptcies with some of these companies, or just companies will sell out for pennies on the dollar because they can't keep doing the normal Silicon Valley business model of we invent our own accounting metrics, we grow our revenues, and we sell shares to pension funds or other suckers?
Yeah, 2 points about me. Yes, I think we're definitely going to see bankruptcies for a lot of reasons we can get into later, perhaps, or talk about the economy later. But I think the other thing that's important to realize is, if you look at this period compared with, let's say, 2000 or 1980 or 2008 for that matter, right now, you're absolutely correct. And most people don't seem to realize this, but the rate of increase in interest rates over the last less than 1 year, since April last year, has been much more dramatic than anything we've ever seen before. The rate of increase, everybody says, well, Volcker, we can, I admire Volcker. We can talk about that later if you want. But, everybody says, compares this Fed with Volcker, but the rate of increase we've had has been extraordinary, from a zero lower bound, 0.25%, if you like, up to, 4.5% in less than a year, is a very, very dramatic change that affects businesses, large and small, as well as households, of course. In this country, unlike most countries in the world, the US has long-term fixed rate mortgages, which is a very wonderful invention, by the way, one of America's greatest 3 inventions. The other 2, in case you're interested, are right turn on red, which is a wonderful, wonderful innovation, but we don't have in England or other countries. And the other one is, those halftime shows of football matches with the pom-pom goals. But it's one of the greatest three innovations. I'm joking, of course, being facetious, but and so at least most people's homes are not affected by interest rate increases in the way that, say, Canadians or British are, where people's mortgages are actually jumping. But it does have an effect on businesses. It has an effect on, if you have a line of credit that used to be, 4 or 5%, and it's now 10 or 11%, that has a significant impact on your business. And we've seen things like used cars and so on, where automobile sales, where interest rates shoot up for the consumer. It also affects government, of course, because the federal government here has, in the last few years, foolishly been financing much more at the short end rather than at the long end. I mean, you know, I don't know what it is, accounting 101 or financing 101. But when interest rates are low, you should take advantage of it and term out your debt to as far out as you can go. You pay a little bit more for 20 or 30-year debt than you do for 1-year debt, but you lock in those low interest rates. And that's what most companies have been doing. Most private companies have been extending, redeeming their shorter term debt, their nearer term debt, and terming it out. The federal government, not just under this administration, but under the last administration, has foolishly been financing at the short end. What they should have done was followed the lead of Argentina and Italy, as well as Austria, companies like Nestle, and start issuing 50-year bonds or 100-year bonds. That would have made much more sense. But anyway, the point is that they have short-term debt right now, which is going to roll over pretty quickly. And so we see right now, for example, we have a $5.8 trillion budget. 1.6 trillion of that is interest payments for last year. Last year it was sorry, let me take that back. $5.8 trillion budget, 800 billion is the rate of interest right now. It was for 2022, it was 475 billion. But if you look at the last 3 months and annualize it, it's 800 billion. So essentially, there's been we're up 42%, 40% in the last 12 months, which is astonishing. Now, as these 6 and 12-month bills and notes roll off, and the government finances at the new higher rate, that's going to go up even more. And that's assuming there's no increase in the federal budget, which is the federal budget deficit, which is not a conservative assumption. It's a false assumption. Of course, the budget deficit will increase, and it'll increase for a couple of reasons. One reason it'll increase is because the budget will continue to go up, because Congress is constitutionally incapable of cutting spending. And the other reason, of course, it'll go up is because when the economy slows, tax revenues go down. When the market slows, you have less capital gains tax. When the economy slows, you have less payroll tax. So the tax will go down, therefore the budget deficit will go up. And as interest rates move up at the same time, and bonds, the short-term notes roll over and the government has to refinance, we're going to see that interest on the debt, that's just servicing the debt, it's not paying off any debt, go up from 800 billion a year. It could easily double from here, easily double. And that becomes a very, very dangerous situation when 25 to 30% of your budget is going simply on servicing debt. That's a danger zone.
That sounds like a third world country, an emerging market, a banana republic, rather than a country with the world reserve currency.
Oh, absolutely. Well, having a world reserve currency, of course, gives you various benefits, or seeming benefits. And one benefit is that you can, I'll use the word print, you can print more money than you need for your own domestic economy without it causing a huge amount of inflation. And the reason for that, of course, is because of the world's reserve currency, other people, foreigners, will take your currency, whether it's central banks, 10 years of, well, I don't know what the number is now, but 10 years ago, something like 75% of the reserves of non-US central banks were held in US dollars. The number's gone down significantly, but it's still more than 50%. So central banks will hold your currency, but equally, ordinary everyday people around the world will accept and use your currency, whether it's, the taxi driver in Romania or the, I'm going to be politically incorrect, the drug dealer in Colombia or the ladies of the night in Argentina. They'll all take US dollars because the dollar is the world reserve currency. And I'm old enough that I can remember when people in certain countries used to take the British pound. They don't anymore. I mean, you try giving a Canadian shopkeeper British pounds and they sort of laugh at you. It may as well be Hungarian zloty or whatever it is. That's Polish zloty or whatever it is. But everybody will take US dollars today. You can go to a Canadian store, they'll take US dollars.
For now, yes, for now. But
for now, and that's the point. The point, yes, absolutely. We can get into this discussion if you want about end of empire, but that's the point. They will take it now. And so the assumed benefit or the seeming benefit of having the world's reserve currency is you can print more money than your economy needs because there's always someone who'll take it. The problem, of course, is when the music stops. And Britain saw that. There were many issues with Britain, of course, but Britain saw that in 1945 when the pound was already losing its reserve status, but at the end of the Second World War, it was abundantly clear to everybody that Britain was no longer top dog. And all those pounds that have been printed and loaned and so on started coming back over the next 15 years. They started coming back to Britain. And so Britain had 20 years, basically, after the Second World War of, let's say, no growth, of a declining currency. The British pound was 5-1 against the dollar. The dollar was $5 to £1 in 1945. And it got all the way down to 1-1. Before Margaret Thatcher took over. We went cap in hand to the International Monetary Fund and the World Bank in the 1960s. I mean, and largely, not completely, but one major factor causing that was the loss of reserve status for the British pound. And the same thing is going to happen to the US economy. When all that money starts coming back and when you're I'm trying to think of something. Yeah, when your Hungarian taxi driver no longer wants US dollar bills, but he'll take Chinese yuan, those dollar bills are going to all start flowing back. Because there's a lot of people around the world, as you know, today, who have savings in US dollars. They have US dollars, a stash of US dollars in a biscuit tin in the kitchen. Once a dollar starts losing its value, and this is a gradual process, it's not a one-time event, but they take those dollars out of the biscuit tin and they take them to the bank and they convert them into their local currency, or they convert them into the Chinese yuan if their own currency is not holding up. But all those dollars start coming back, and that's going to be very, very damaging for the US.
It seems like all these different governments, especially with the behavior, the policies that these governments chose during the pandemic, shutting down supply chains, issuing people stimmy checks, increasing government debt. There was a lot of debt monetization by a lot of different governments that it seems that we may have a global government debt crisis in the next 2 or 3 years. Japan finally seems to be hitting their limits after about 30 years. The European Union, especially Germany, I think spent around $500 billion on energy imports. That doesn't seem sustainable to me, to be paying that much of their GDP for oil, natural gas, coal, wood, just to survive the winter so they have enough electricity and heating. So it seems like we're finally getting where all these governments with debt, not just the US, maybe they're saved for last, are finally having to deal with this government debt crisis math problem.
No, you're absolutely right. We've never really seen anything like this before that I can think of. And so we don't really know how it's going to end. And that's why we're seeing so much so much discussion about, the Great Reset and so on. Ironically, China has been one of the more responsible, and I use the word, in a comparative sense, they've been one of the more responsible governments over the last 10 years in terms of money printing. But you're absolutely right. And so the US is in a situation where the US has, with few exceptions, third world countries, and with few exceptions, the US has had as loose and easy a monetary policy over the last 10 years, and particularly over the last 3 years, since COVID, and then over the last 13 years, whatever, since the great financial crisis. They have had as loose a monetary policy as pretty much anyone in the world, other than Japan, of course. And yet, because they're the world's reserve, because the dollar is the world's reserve currency, their decline will probably be slower than many other countries. There's that old saying, there's a lot of ruin in the country. And it takes a long time for these things to play out. And so the interesting thing, we saw the dollar remarkably strong over the last couple of years. And, the obvious answer, people often said, why? But the answer everybody gave, which is the correct answer, is that, in many ways, it was the cleanest shirt in the dirty laundry hamper. But other countries were doing just as much. And of course, being the reserve currency meant it had a certain safety factor attached to it, but other currencies didn't.
Well,
but you're right.
Also, Adrian, these things work in cycles with dollar weakness and dollar strength, because when the dollar's weak, you see an increase then from foreign governments and foreign corporations. They go and take out more dollar denominated debt. So then that creates more demand for dollars. So these things tend to go in a cycle until we're in a new system. So that's why 12 to 18 months ago, the dollar was weak. You heard Peter Schiff and other people talk about, and David Hunter, I think, was talking about dollar index to 85, prediction like that. But that was, then you started seeing the headlines that these foreign governments and these foreign corporations started increasing the amount, I think $400 billion worth of dollar denominated debt in 12 months. So they were trying to take advantage of that, but then that reverses the cycle.
Well, sure. And the other thing that happens is the US stock market and bond markets and real estate markets are still the largest of their type in the world. And so when the dollars declined by so sharply, global investors start looking to buy US stocks, for example, because they are, very cheap for them. There's that old saying you probably heard that the solution for low prices is low prices, and the solution for high prices is high prices. So absolutely, you see that. But you also reach a point. You reach a point where people lose confidence, whether it's in a currency or a country or a stock market, and then the cycles become longer. And so you saw that with Britain, where you had essentially a 35-year cycle where people were just losing confidence in the pound and in Britain, and the currency declined over such a long period. So we're not there yet. As I say, these things take a long time, and there's a lot of ruin in the nation. We're not there yet, but I think we're going to get there at some point. The big difference, we can talk about some people like to talk about the parallels between the US Empire and the Roman Empire. And, there are some commonalities to the end of every major empire. Frankly. But if you look at Britain in 1945 and compare with the US today, there are certainly parallels. Huge debt, unfunded liabilities, military bases around the world. One might argue, a little more contentiously perhaps, one might argue about the loss of discipline and hard work ethic, and also a certain what's the word I'm looking for? Easy morals, if you like. You saw that in Rome before Rome collapsed. You saw it in Britain in the 1930s, where the 1930s and 40s, where the elite of a country was very, very what's the word? Debauched, if you like. And you're seeing that in
like
the
Lord
US.
Keynes.
Well, yeah.
Hedonistic, yeah, like Lord Keynes.
You certainly saw that. You had the Bloomsbury set in England, and you're certainly, I think, you're certainly seeing that in the US today. But there's one, and all of these things are signs of the end of empire. You saw it in France, and you certainly saw it in Rome, you saw it in Greece. But the one major difference that leads towards, which is in support of the US, if you like, is that in 1945, when Britain had just come through a war that basically bankrupted it, and America, we thank America for supporting Britain in the Second World War, but it was the land lease. Remember, it wasn't Britain. America didn't give grants or gifts to Britain. They were all loans, and Britain was basically bankrupted at the end of the war. We had a lot of debt we had to pay back. Sorry, where am I going with this? Gosh, I'm sorry, Jason. I've forgotten where I was going with this. Oh, I know. Yes, sorry. So it was very, very obvious to people that Britain's best days were behind it. But the crucial factor in 1945 is it was very evident to everyone in the world that America was taken over. America was the dominant political, the dominant military, and the dominant economic power in 1945. And Britain was, I won't say happy, but Britain accepted and passed the torch to America peacefully, if you like. Where we are today, a lot of people are talking about China already is or will be soon the world's leading economy. It is not yet, but it will be the world's leading military power. But America is not going to pass the torch to China in a friendly manner. And that is the huge difference between the two. And so in the 1930s, as America was rising and Britain was declining, and certainly at the end of the Second World War, the handoff to America was very quick. And we've seen that before in history. We've seen that before in history. After the Dutch Empire, when Britain took over from the Dutch, very quick and very and relatively peaceful. But this is not going to be like that at all.
Would you say that this is the toughest time in your career for risk management, where you're trying to figure out, it seems that the market is literally guessing on the words of Chairman Jerome Powell. There's incredible volatility. A lot of asset prices are going up and down. I mean, we have moves in currencies and exchange rates that are happening in a couple weeks that in the past might not have happened in an entire year. So is this the most difficult time in your entire career to actually?
Yeah, we've had a couple of cases like this before, but you raise an interesting point. For me as a money manager, and other value investors will say the same, we have more flack from clients. We lose more clients when our relative performance lags the market, not when in absolute terms we're down if other people are down and other sectors are down. And so we're not getting that yet, because I think most investors, certainly most of the people that are our clients or potential clients, recognize that this is a pretty crazy period. But, the last 3 or 4 the last 3 or 4 years of the 1990s was a very difficult period for us, because even though in some years our accounts were doing fine, no problem, but we were not in the dot-com bubble. And so people would say, hey, I just doubled my money in 2 weeks on, dotbasket.com or something. And why aren't you doing that? And my next door neighbor, he's in this, high-tech fund, and he's tripled his money in a month. Why aren't you doing this? And so, so those periods become the most difficult periods for people. 2008, when the S&P was, I think, down 40%, some of our accounts were down 30%, some were down 45%. And, I don't say nobody cared. That's not true. Of course, that's not true. But we weren't getting people calling up and canceling their money, canceling their account, because they didn't have anywhere else to go. So in a period like this, you have the same sort of thing. We saw it a bit last year with Bitcoin, frankly, until Bitcoin blew up. Everybody was saying, why aren't you in Bitcoin? Because I'm making so much money in Bitcoin. You always get that. You always get that when there's a mania. But we're not seeing that right now, because I think people recognize, well, first of all, it's only been a very short period of time we're talking about. But the US stock market, to me, is when you're a value investor, you really just have to stick to your guns. The worst thing an investor, and in fact, the worst thing any type of investor can do, in my mind, is to change their methodology in reaction to short-term movements in the market. So, but the person that buys a stock because he's a value investor who really understands value and is going to hold for a long time and doesn't care about the volatility, he suddenly dumps a stock after they drop 20 or 30% at precisely the wrong point. Or the momentum investor that buys on momentum, but when the trade goes the wrong way, he suddenly decides he's going to hold on to it for a while. So those are the worst mistakes. And so when you're a value investor, sometimes the pickings are rich. And frankly, for the last 10 years, since the market took off on all this excess money, it's been I would say not just right now, I would say the last 10 years have been a difficult period, because they've been a difficult period to find genuine value. And for me, value is not just things that are selling below their intrinsic worth, but I also want a quality company selling below its intrinsic worth. And those have been pretty few and far between, frankly, over the last 10 years. I am looking forward to, the silver lining in the cloud, which is, I think, over the next 12 or 18 months, we will begin to see good quality companies trading at low multiples. I mean, look, if we may, I don't know if you want to go in this direction at this point, but if you look at the US stock market today, we had a bear market last year briefly. We got into bear territory. The lowest the price earnings multiple got was 18. 18 times earnings is not cheap. If you exclude the last 12 years where the multiples were high because of excess liquidity in the system, when the Fed creates excess liquidity, that money has to go somewhere, as you know. And a lot of it goes in the last 12 years, a lot of it went into assets.
It went into index funds too, yeah.
Including index funds and stocks in general. And so if you exclude the last 12 years, 18 times earnings has pretty much been, other than a few exceptionally short periods, like the dot-com bubble, it has been the high end of the range for stock market valuations. And so
and those are large cap companies with really no growth. So the companies doing financial engineering, they were doing share buybacks to grow earnings per share without actually growing the company. No new products or services. They're not growing revenue organically. So they were taking advantage of the cheap debt, normally with share buybacks.
Absolutely. And so bear markets don't end at 18 times earnings. If we've seen the bottom in this S&P, if we've seen the bottom last October, this will be one for the history books. It really will. Right now, the S&P is trading. I'm going to give you, if I may, I'll give you the numbers as they are right now. The S&P is trading at, well, it's now 18.3 times earnings. It was 18.7 last week, so shows you how quickly it changes. But here's a point I want to make. Earnings in the last 12 months were $223.31 per share, per S&P share. The analyst expectations, now hold on to your chair here, I hope you're sitting down. Consensus analyst expectations for earnings per share for the next 12 months are $223.30 per share. That is down 1 penny per share from last year. That is, let's just say that is a rosy forecast, and let's just say that there's certainly risk in that forecast not coming true.
Well, I mean, just listen to the conference calls. Look at the headlines in the conference calls for the fourth quarter that we're starting to get out now. Mass firings, companies still have high costs from inflation, supply chain problems. That doesn't seem to me like earnings are going to be rosy then.
Well, and I was being extremely understated in what I said. I think it's baloney. It is baloney to think that earnings per share are going to be flat this year. So there's incredible risk in the market. If earnings per share decline by only 10%, and they'll probably go down by more, certainly if we have a recession, they will. When earnings per share go down, typically the price earnings multiple contracts. So if the price earnings multiple goes to what would be the average multiple for the last 25 years, and the high multiple prior to 2012, and earnings per share declined by 10%, you've basically got another 20% decline in the stock market from here. And I think that's I would call that a reasonable working assumption. So people are not prepared for that. People are just not prepared for that.
But in that scenario, Adrian, then government finances become precarious because interest payments on the debt are ballooning with these high interest rates. The Fed is basically trapped then because in 2008 and 2020, the Fed had to step in and go and buy U.S. Treasuries. The Fed even had to buy municipal bonds to help bail out state and local governments in those recessions or depressions in 2008 and 2020.
I agree with you completely. I mean, we're really entering unprecedented times here in the economic sense. And part of a problem, of course, I think you'll agree with this, but part of a problem is that the easy money lasted for so long, just like in the 1920s. You know, when you have easy money for a long, long time, then the correction, the liquidation is that much more damaging. And if you try to make it less damaging, which is what the Fed has been doing, the government and the Fed have been doing, and I think of the Fed as basically just an arm of the government at this point. But if you try to make it less damaging, which is what the government did to housing in 2009, you know, most pathetic thing they did, start buying mortgage-backed securities to support the housing market. You know, you've got to let these things find their natural level. And the sooner they find their natural level, then the sooner the recession will be over. We know that. And there's always people with money who are ready to buy at the right price. It's not as though markets just completely dry up or go to zero. But, you know, they seem to think, I don't know, they seem to have this sort of concern that if they don't do something, you know, the world's going to just fall apart. And right now we've had easy money, not just for the last 3 years since COVID, not just for the last 12 years since 2009 with after the great financial crisis, but really since Alan Greenspan, who should have known better. But Alan Greenspan pursued a generally easy money policy. And he also introduced the Fed put. It used to be called the Greenspan put, but then after he stepped down from Fed, it became known as the Fed put.
It's gone from one, it seems like, Adrian, and you've been doing this a lot longer than I have, it's gone from one asset bubble to the next. So when one asset bubble collapses, they either try to reflate that existing asset bubble, or they go on to the next asset bubble. And this ties in with the Austrian School of Economics, the theory of boom and bust, with artificially cheap credit, currency and credit.
No, absolutely. And if you've got this excess credit in the system, it has to go somewhere, right? I mean, obviously, it has to go somewhere. So if a technology bubble pops, people can either put their money back into technology or they put it somewhere else. But the money has to go somewhere. And
if you're the chief financial officer, senior executive of one of these S&P companies, and you have assets and you have cash flow to borrow against, I mean, and the Fed has almost zero interest rate policy or close to it. I mean, you've been just borrowing rather than selling a lot of equity. You've just been borrowing more and more debt for years.
Right. And for 15 years. And as I say, I would argue that before that, since the 1990s with Greenspan, money has been cheap. So why not borrow it cheap? Now, the sensible companies, and there were a few, they borrowed money at low interest rates in order to pay off their high interest rate debt, term out their debt, and get fixed debt. So that made sense.
Smart acquisition. I mean, if you can grow your cash flows, if you can buy free cash flow with cheap debt, I mean, and then it pays off your debt. So
of course. But as you say, too often, too many times, and this always happens. I mean, this is an inherent result of easy money. It allows companies to start that should never have started. It allows zombie companies to continue much past their sell-by date, and individuals, take on more debt than's necessary. And as I say, the one saving grace for the US is that most mortgages are long-term fixed rate. But credit card debt, for example, the average interest rate on credit cards now has just moved up to 19%. And for a lot of cards, for a lot of lower credit borrowers, cards are 25 and even 29% right now. And so, those are enormous. That's an enormous interest debt.
Oh, we're going to have a bubble. Yeah, a bust. I mean, we're going to have a bust for sure.
For anyone to bear. Well, you've already seen it. Cards from Capital One, Discover. They've already talked in their latest quarterly earnings. They've already talked about the huge increase in carried balances and in write-offs. So they're already seeing charge-offs. They're already seeing the credit card companies taking charge-offs. And we've only had these increased debts for the last 9 months. And the problem is, as you know, as Milton Friedman famously said, that there's this long and variable lag in monetary policy. And its effect on the economy, whether rates are going up or down, monetary policy works with a lag. And so interest rate sensitive areas like housing and like automobiles, where most people who buy a house and many people who buy a car, perhaps most people who buy a car, finance it. And so these are very interest rate sensitive areas, and they react to increases in interest rates and decreases in interest rates very, very quickly, very soon after they start. But other sectors of the economy, it takes longer. And a good example that I like to talk about is the consumer. If you look at consumer spending last year, from when the Fed started raising rates in April through to the end of the year, it was marginally up, essentially flat. And so a lot of the apologists would say, look how strong the consumer is. Look how strong the consumer is. Retail spending hasn't gone down. Well, when inflation's at 8 to 10%, when prices are going up by that amount, you should have an increase in retail spending for people just to stay where they are, right? That's the first point.
Well,
so
yeah,
people,
the consumers' costs are going up. So yeah, it's inflation that's driving the spending increase. So that's the point you're making, right?
And so if people are only spending a little bit more than they were before, it means their standard of living is going down. They're buying less, or they're buying cheaper quality goods or something. That's number one. The second point is, if the savings have collapsed, under COVID with all the government programs, there was this huge increase in savings. People were locked down. They were getting government checks. They didn't have so many places to spend the money. And unlike most government, handouts in the past, it didn't, which go immediately on consumer spending, immediately. You saw this with, Obama had, what was it? Some tax rebate thing, giving everybody $100 or $500 or whatever it was. I didn't get mine, but and that's immediately spent, typically, right? People just go out and spend it. Under lockdown, a lot of that went into savings. So credit card debts, credit card balances came way down, and you saw an increase in spending. That has been completely reversed in the last 12 months, completely reversed. So what it means is that, yes, people are still spending $1,000, but the $1,000 is buying them less than it did, number one. Number two, they're doing it out of savings. And then in the last 2 to 3 months, we've started to see the credit card balances go up. So just think about it. It makes obvious sense. Prices are going up, but you still want to put cereal on the table for your kids. And you still have to buy a new pair of trousers because the other ones are worn out, etc. You still have to fill your car with gas, etc. So you start depleting your savings. When the savings are gone, you start racking up on credit cards. What comes next? That can only go on so long, right?
Yeah, you start to have bankruptcies. I mean, we're starting to see in the headlines people losing their jobs. So people are getting fired at six-figure technology or S&P 500 company jobs. They're not going to be able to get another six-figure job if they lose their job. They're probably going to have to either get a couple part-time jobs or they're going to get a lower paying full-time job. So
absolutely. And so retail sales tend to have a bit of a lag. Employment is another area which has a bit of a lag. Maybe we don't have time to go into it now, or it's off topic, but to point to the low unemployment rate as a sign of how strong this economy is and how we're not going to have a recession and interest rates are not yet affecting employment is just absolute nonsense for a lot of reasons we could go into. But one, if you want, but one thing I'll just say now, and that is over the last 40 years, the unemployment rate has always been at its lowest point immediately before a recession. And that's because employment works with a lag, as Milton Friedman said. He wasn't an Austrian, but he did say several things that made sense. And one of which was that monetary policy works with long and variable lags. And it works with a long lag on employment for a lot of reasons. I mean, if you have a small firm like mine, you laying people off is the absolute last thing I do when there's trouble. I cut expenses. I try to get a loan from the bank. We don't replace their computers. We cancel the monthly employee dinners. But laying off people is the last thing you do. And for big companies, they don't have that close personal connection with their employees. But still, you don't lay off people in a market like this, an allegedly hot employment market. You don't lay off 1,000 people if you think you might need to bring them back. And so now we're seeing these huge layoffs from, as you say, Amazon, and whether it's layoffs or whether it's hiring freezes, Ford, Boeing are the latest two, Amazon, Apple. I mean, you mentioned a couple too, huge layoffs from these companies. That's a sign that there's tension in that company. And so it's a result of higher interest rates. And we're going to see more of it.
Yeah, so I think all the things we just discussed the last few minutes, it means, and I think you'll agree with me, that the higher interest rates are not priced into stock market valuations, the real economy yet, consumer spending. It's just starting to. So we've seen some of the asset prices have enormous volatility, but we have not seen the full effects of the higher interest rates, all these rapid rate increases the Fed has done yet, especially for government finances, but tax revenues, tax receipts, and now with people potentially losing their high-paying jobs.
Absolutely. You put it very well. It's not reflected in the economy, but it's not reflected in asset prices, definitely.
So do you think then that inflation is peak? Because it sounds like temporarily we could have disinflation or deflation, maybe with the consumer price index coming down. But I don't think historically, at least, that government's response to this normally is to figure out ways to inflate debt, or at least the central bank's going to make sure that they buy government bonds or municipal bonds and to try to inflate that debt or buy the debt to soak it up.
Yeah, no, absolutely. And if we look back to the 1970s, which was the last, big long inflation in the US, you had periods in the 70s where the CPI rate, I should say, where the CPI rate, started to come down. So I think we're entering that period now. I wouldn't be surprised. Next month's going to be a difficult one because the gas price, which is a major component of people's spending and a major component of the CPI, the gas price has started to pick up again a little bit. But I wouldn't be surprised if, let's say, over the next 3 or 4 months, the trend is for the CPI the rate of increase in CPI to come down. Now, remember, we're talking about a rate of increase. As one of my friends, Lobo Tigre, says, it's like you're climbing Everest. Well, every so often you come to a sort of plateau, but that doesn't mean you're going downhill. You're just going uphill at a slower rate.
Yeah, these PhD economists and the people on Wall Street and the mainstream financial media are spinning it as if inflation has peaked. But you're a business owner, Adrian. You managed money professionally for a long time. You know that it's a new normal of cost structure. The costs are just way higher, and the government economic data is not really accounting for this.
Absolutely. Well, it's interesting because I read something today. I forget who said it, but he said that governments tend to look at things on a rate of change, but consumers tend to look at it in absolute terms. So if prices only go up by 2% in the next 3 months, that's 2% on top of 8% for the last year. It's not, we're not seeing a decline in prices. And that's a critical point. So, I mean, again, in the 1970s, you saw periods where the rate of increase in prices came down fairly significantly, but then shot up again. And so I fully expect to see that this time around. But I think it'll come as a shock to people.
The difference this time is there's no Paul Volcker, though. So if they take the rates to 18%, I mean, there would be so many bankruptcies. The governments can't even afford interest rates. I would argue the US can't afford interest rates at 5, 6, 7%. Japan certainly can't afford interest rates at even 2 or 3%. So I don't think there's going to be a Paul Volcker this time to take rates that high.
No, I think you're absolutely correct. No, absolutely correct. I mean, and the reason I think is that it's been going on for so long. So all this loose monetary policy is built into the system. All of the excess, all of the bad loans or the loans people shouldn't have taken, all of the zombie companies. It's been going on for so long. But the problem is much more difficult to fix. And people forget. I have respect for Paul Volcker. And I make a joke. Well, never mind. But when Volcker came in, the rate of the federal funds rate was already more or less about the same as the inflation rate. We're not at that situation now at all. If you look at the government numbers for the CPI and the Fed funds rate, you've got a huge gap between the two. And in order to kill inflation, I think you'll agree with this, in order to kill inflation, not just slow it for a little while, but to kill it, you have to get interest rates above the rate of inflation. on a consistent basis for a period of time. Rates have to go above the rate of inflation. So the thought right now that the Fed would raise short-term interest rates to 8 or 10% is almost unthinkable. And nobody's talking about it. I mean, nobody is suggesting that's where rates should go. But if they did get anywhere close to that, then yeah, government finances and the economy and pension funds and everything else.
Well, the Fed is trapped. Then they have to start doing bailouts, and they have to start buying more government debt and bailing out different parts of the government then. So it seems like the Fed has trapped itself.
The Fed is trapped, and as you said, I'm glad you said it's trapped itself, because this is a problem of their own making. But I mean, I often say to people, my friends, you know, Dr. Ron Paul, if you were made head of the Fed right now and Doug Casey were your Treasury Secretary, I mean, could you solve this problem in a short period of time? Let's say you could do any policies you wanted and the Congress would go along with it. I think it's an almost intractable problem to solve in the short term without extreme pain in the economy.
Well, I don't think DC would agree to it. That it would mean cutting the size of government and government spending by an insane percentage. There's no one in DC, either political party, that would agree to it. There's so few people that are even talking about the debt and cutting government spending now. There's only a handful of people really in either party that are even talking about this in Congress right now.
No, absolutely, absolutely. And I mean, you know, we could focus on, you know, these sort of $500,000 grants to trans whatever theater.
I mean, that's the numbers sound large, but it's such a tiny percentage, and so much money.
That's all small.
That's like a dinner for the Pentagon now. That's like one dinner. Waste.
What I would say is it would be a good place to start. Let's just cut out all this absolute crap. You know, these performance theaters that nobody goes to, but they get grants from, you know, the whatever they're called, from the government.
It's all grift. Yeah, it's lobbying and grift, and they know someone, they know a friend or family member knows someone, and someone got him an unbidded contract. Sure. It's there's so much waste.
And the congressman wants to support people in this district, and so he shows he's bringing it home. But you know, you look at Social Security, for example. I mean, you and I both know, and most people know. Well, actually, most young people today do not know. They do not know the Social Security started as an insurance program. That was the idea. The idea was that you worked, you contributed. It was a forced savings plan, which, you know, I don't like, but it was a forced savings plan. And when you retired at a certain age, based on your contributions, then the government will pay you X amount of money per month for the rest of your life. And it was meant to. But
the life expectancy, Adrian, back then when FDR started it was only around 70. It was in the high 60s or so.
It was 68. That was the second point I was going to make. So the first point is it was meant to be an insurance program. But of course, over the years, they can't help themselves. They've tacked on all these other things, the biggest one of which would be disability. And I would venture to say, I might get hate mail on this, but I would venture to say that a significant number, I was going to say majority, let's just say a significant number of people who are on disability are not what, you know, well, I can't speak for you, are not what I would call disabled or used to be disabled and are perfectly capable of working if they want to. But, you know, they've added disability, they've added all sorts of things to Social Security. So it is no longer just people working, contributing money and getting that money back in an insurance program. And the second thing, of course, as you just mentioned, life expectancy has changed. So people were actually writing about this and talking about this in the early 1950s, if you can believe it. You know, but we can't carry on at this rate. We have to start making changes. And the most obvious change to make, you know, it's a politically charged issue. So do you want to cut people's payments? Probably not. You could means test it, but people would say, well, I paid all my life expecting to get it. It's unfair that I don't get it. The most simple and politically easy solution is to say, for example, everybody under 40 doesn't get Social Security till they're 70. Everybody under 35 doesn't get it until they're 75. And every year just raise it. I mean, if the average life expectancy has gone up by 20 years since it was introduced, not quite 20, by about 17 years since FDR introduced it, we need to start increasing the rate of the age at which people get Social Security.
That's a logical, rational type of thing to phase out the government spending and reduce it. But that doesn't poll well. Instead, you have politicians like Joe Biden and others promising that you're going to get your student loan debt waived. So that's money. That's not even their money. And they're saying, I guess they're just assuming the Federal Reserve Bank's going to create dollars out of thin air and buy up student loan debt in exchange for people voting for that politician.
No, absolutely. Well, one of my bugbears, I've got lots of bugbears. As you get older, you have more bugbears. You'll find out. But one of them is when you read these headlines or hear on the news, President Biden to give students, blah, blah, blah. President Biden's giving this. He's not giving anything. He's stealing it from taxpayers and passing it along.
Yeah, it's a bribe for a vote. Yeah.
Yeah.
Yeah, they don't like seeing the truth here in DC. I mean, it's all spin. It's putting lipstick on the pig, as they say on Wall Street. As we wrap up here, Adrian, I want to get your thoughts, though, on commodities and gold stocks. I know you love gold royalty companies. I've read your interviews over the years, and you've talked about how gold royalty companies are actually, diversified. They have good profit margins and free cash flow. Do you think then in this type of interest rate environment, commodities are kind of hated now because a lot of the regular money managers on Wall Street are like, inflation has peaked? Do you still think that commodities have a good long-term perspective here? And for risk reward, for valuation, some of them are starting to get interesting again.
Yeah, 100%. I would separate gold, which is a monetary metal, from, copper and uranium and the others. But gold, I think, is the lowest or the best risk reward ratio of any asset right now in any market. And there's a lot of misconceptions about gold. People think, well, if why didn't gold go up last year when inflation was going up? And now people are reversing that and saying, well, if inflation's coming down, we don't need gold. It's a misconception. The correlation between gold and current inflation is not particularly high. When the economy starts falling, what's the biggest correlation is, does the market expect that the Federal Reserve is going to defeat inflation? That's the biggest correlation. And you saw this in the 1970s. People forget that under poor old Arthur Burns, who's often held up as, the worst Fed chairman of all time, and who let inflation get out of control. But people forget that under Arthur Burns, he was increasing interest rates month after month, quarter after quarter, for multiple years in the 70s. But, and the big but, is they were always lagging in consumer prices. They were always lagging inflation, using the word inflation as a synonym for consumer prices, which of course it isn't. But they were always lagging, and the market did not think that Arthur Burns had the fortitude to do what was necessary to kill inflation. When Volcker came in, not only did he jack rates above the rate of inflation, but the market believed him when he said he was going to kill inflation and there would be a recession. It wasn't even if it takes a recession. He said there will be a recession. Right now with Powell, Jerome Powell sort of tries to be hawkish, but I don't think he and the market is a little bit torn on it. Will he or won't he? But I don't think they're going to. I don't think they are going to. I don't think they can do what is necessary to kill inflation.
Well, the spin from the spin from DC, the spin from the PhD economists at the Federal Reserve Bank, the spin from Wall Street is that we're not going to have the R word, the recession word, and that everyone's talking about soft landing, but the track record for the Federal Reserve Bank and soft landings is close to zero, basically zero.
The track record for the Fed predicting anything, predicting inflation, predicting GDP, as you say, predicting interest rates even, is pretty abysmal, which is sort of surprising when they're the people that, they're the people that select the short-term interest rates anyway. You'd think they'd be able to predict it. So I think gold is going to is going to have a very, very good year. And typically, as the economy starts slowing, unless inflation is truly under control, which I don't think it will be, then people are going to look. Markets are forward-looking, as you know, and that's why the current correlation between today's inflation and today's gold price is so low. The markets are forward-looking.
Well, I think the gold demand is increasing, not necessarily because people are worried about inflation in the short term necessarily. I think people are worried about, similar to October 1929 crash, about bankruptcies in all these companies and sectors, and gold is a bankruptcy hedge at this point. Absolutely. No, that's what I'm saying. Gold doesn't react to inflation going up absent other conditions. So gold is moving up now, as you say, for the reason you just said, and that's why I think it will continue to move up. Gold stocks also are a good buy. And again, people think, well, if there's a recession, gold stocks are going to do badly. But in fact, if you look over the last 40 years, gold stocks have done well during recessionary periods. Not only inflation
that,
and deflation,
absolutely. But not only that, I mean, the gold stocks are very close to their 20-year lows in terms of valuation. You look at the XAU, which is the index of leading gold and silver stocks in the US, and you look at, say, the price to free cash flow or the price to net present value. And other than a few blips like the end of 2015, they are trading at 20-year lows to multiples. That simply doesn't make sense when gold is at 1850 or whatever. The all-in, you look at a company like Barrick, the second largest gold mining company in the world, their all-in sustaining cost, which is a metric they use to include all costs, including the costs of ongoing expansion and so on, replacement of reserves. They're all-in sustaining costs of $1,200, and their cash costs, the cost to produce an ounce of gold, is less than $800. That's their current numbers, including the inflation we've had over the last 12 months. So if your all-in sustaining cost of $1,200 and the product you're selling is $1,850, you've got a pretty darn good margin there. There's room for that margin to shrink, and yet the valuations of these companies are at 20-year lows. So I think the gold stocks are an incredibly good buy right now.
And I think this is why we're starting to see more mergers and acquisitions in the space. Newmont just put in a bid for the largest gold miner in Australia, Newcrest, and then we just saw Yamana Gold, which was the lowest cost gold miner in Canada and South America. They just got their assets split up by Agnico Eagle and Pan American Silver. Right,
and so the companies are trying to take advantage of the current prices before they go up. You asked about commodities. The thing that could really hurt commodities, of course, is if the world goes into a sharp recession. If we have a global recession, that would hurt commodities, and we mustn't forget that. But absent that, if we have a sluggish global economy, if we have a recession in Europe and a recession in the US, but China and Asia are still doing well, ex-Japan, of course, I think some of the commodities will be very strong. And the commodities that I'm focused on are not only those that have a good demand picture, but particularly those where there are constraints to increasing supply. So copper, for example, would be my favorite, because copper mines they take a long time to develop and build. You can't just say, well, the price of copper's up, let's increase our production of copper. It doesn't happen that way. And so we can be pretty sure about what the supply of copper will be 3, 5, 7 years from now. You can be reasonably sure.
It's actually falling. Even though copper prices were high, 12 to 18 months ago, they hit $4.50, almost $5 a pound for a brief period of time. I mean, no new copper mines came online. And actually, I think I just saw an article out of Chile, which is the world's largest copper producer. 7 out of their 10 largest mines are all in decline now.
Well, absolutely. Well, these are old mines. I mean, Chuqui's over 100 years old, 150 years old. Most of the largest mines in the world are very, very old. And as mines get older, their costs go up and their production inevitably at some point starts to decline. But yeah, the Chilean mines are going down. And you've also got the political problems in Chile, in Argentina, in Peru, which would otherwise be the most attractive places to build large copper mines. And so Freeport, which is the largest when I say private, the largest non-government copper company in the world, they're not building any new mines at the moment. And because of concern about the political risk, not because of the current outlook for copper. And so the production of copper, I'm not saying in 10 years' time it can't be higher. I'm not saying that at all. And I'm not saying the world's running out of copper and there is no more copper or anything else. I'm just saying the copper mines, which tend to be very large, tend to have long lead times for Freeport CEO was asked a question about if they change their mind, how soon could they bring mines back on? And he said, our shovel-ready projects will not be producing for 4 to 5 years if we decide to make a production decision.
Yeah, I mean, their size mines are billions of dollars. So if they're going to invest in a new project, I mean, most of the mines are a couple $1 billion minimum to build a sizable copper mine at this point.
That's absolutely right. And that's different, of course, in gold or silver, well, gold in particular, because you can have a profitable gold mine that's producing, let's say, 50 to 80,000 ounces a year for, 8 to 10 years. That's a profitable, decent-sized gold mine. Even though the permitting is getting longer and longer in many parts of the world, including the US, but you can still bring that online within a couple of years if it's ready to go. If you've got your permits, if it's shovel ready, and
there's permits, infrastructure. So if it was an already producing mine, say 10, 15 years ago, and there's an infrastructure and power, yeah, you can bring it back online for probably 100 million or less. Yeah. And in
a short period of time. But you can't do that with copper. It takes time. So anyway, the point is, so we know with reasonable certainty what the maximum production of copper in 3 or 5 years is. And so if the world doesn't go into a global recession, the demand for copper is going to continue to go up, both from normal traditional uses, from infrastructure spending in China, and from electric vehicles. As you know, electric vehicles take about 5 times as much copper as internal combustion engine cars.
And DC subsidizing the electric vehicles. I mean, I just see it's almost every month now, new legislation proposed to increase subsidies for electric vehicles.
I know, absolutely. They can't help themselves. And even though I bet you Joe Biden, he's not the only one. I bet you AOC, these people don't realize that when they ask for offshore windmills and they ask for solar farms and they ask for EV electric vehicles, they don't realize that they're also asking for more copper mining and more nickel mining and more steel production. They don't see the connection between the two. But yeah, absolutely. So things like that have a supply constraint are the ones that I'm most in favor of. So copper would be number one. I think oil and gas, frankly, but oil is also going to be very powerful over the next 3 to 5 years because there's been such a lack of investment in the last 4 or 5 years, partly for economic reasons, but also largely for political reasons. I mean, when the government of the US and the president of the US treats you as his enemy, tells you you're making the planet dirtier, tells you he's going to shut down the business by 2030. Oh, but by the way, will you produce more in the meantime, please? It doesn't work. I mean, it just doesn't work that way. And so we've had this incredible underinvestment in the last few years.
Yeah, there's problems on the supply side with a lot of different commodities. I would argue uranium, we need nuclear power too, and food and I mean, look at all the fertilizer plants that are shut down. So we're going to see problems with that, with higher food prices and shrinkflation in the coming years as well. The other component of this, Adrian, I've heard you talk about royalty companies a lot over the years, is that the banks aren't financing as much of these mines or oil and gas projects as possible. So I think there's a really good market niche in the capital structure for a lot of these royalty companies to come in because they have free cash flow, they have cheaper cost of capital, they have access to cheaper debt. So they can come in and they can help finance additional new mines or oil and gas projects going forward, because the banks used to do a lot of this financing. Now the banks are out of it because a lot of these banks, large banks, are into ESG.
No, absolutely. And also, as the equity markets become more vulnerable and more volatile, raising equity for these companies becomes more difficult. And so what you've seen, you raise an interesting point, what you've seen over the last, say, 30 years is you've seen a change from royalties and streaming being the sort of last resort for a developmental company to being a normal part of a financing package. I mean, if you're building a new mine now, there's always debt, there's always some equity, and there's fairly normally, not always, but normally, a stream put on top of it as well. It's just a normal part of financing now.
And if you're a junior, to add your points there, if you're a junior miner and you get an equity investment, say 10, 20%, Franco-Nevada or Sandstorm Gold invests in your junior mine company because you have geologists and you have a good project, that's going to make it easier for you to go and raise capital and move your project along too.
Of course, it's a bit of a sign, a bit of an endorsement in many ways, or it's seen as an endorsement anyway.
Yeah, so letting these companies buy a tiny royalty, a 1% royalty or a 2% royalty in exchange for allowing you to get financing and build a project out, I mean, it's a necessary evil for these junior miners, especially in an environment, like you said, where they can't raise equity normally.
No, absolutely. Absolutely. I mean, the accountants do their numbers, and there'll be times when equity is cheaper, there'll be times when debt is cheaper, and there'll be times when a stream, which is like a royalty, when a stream is, cheaper. Nobody likes to give up the upside, but sometimes it's just a cheaper way of financing. Because if you're building a mine, you have to dilute. You have to dilute at the mine level or at the company level. If you raise equity, you're diluting. If you're borrowing money, you're diluting. And if you issue a stream, you're diluting. But you have to dilute if you don't have the capital already yourself. You have to dilute in order to bring the mine into production. It's just a matter of what is the least dilutive and the most favorable at any given point in the market.
Yeah, I think what the average retail investor doesn't understand is that a lot of these companies, if they have only one or two mines, they're a small or medium producer or junior, and they basically have to bet the whole company on the one mine. So if they're taking out a lot of debt, I mean, that's onerous to go and gamble the whole company on just one mine. And then, as you know, since you've been investing in the sector so long, there's so many risks. There's tons of delays. There's very few new mines that come in on time and on budget.
Yeah, no, absolutely. Absolutely. And that situation has got even worse in the last couple of years with, with the prices moving up. Very few mines are built on time, on budget nowadays.
And now in emerging markets, Adrian, where the dollar is strong, these emerging market currencies are weak, and that's where a lot of the mines are going to be built. You're seeing these workers protest now. They want higher wages. So that's going to be an additional cost for building a new mine that's not priced in yet.
Yeah, no, absolutely. No, I agree with that completely. I mean, the largest cost of running a mine is energy. The second largest cost of running a mine is the local costs, which include a local labor. And so a strong dollar has actually helped these mines in the last few years. We forget, you look at look at the Canadian dollar right now. 134 was 140. Well, back in 2011, it was sort of pretty much 1-to-1. It was over $1 Canadian dollar per US. I mean, over $1 US per Canadian dollar. The Australian dollar, 72 or whatever it is right now. Again, that traded at a premium back in 2011. So costs are much, much lower today for mining companies. Oil back in 2011 was over 120 for most of the year and got to 140. So the costs for mining companies are much, much lower today. And yeah, they're going to get higher. There's no question about that. But the margin right now, I think, is sufficiently large that they can absorb some higher prices.
Yeah, costs will eventually trend back higher because energy prices will go higher, labor will go higher. The other thing is falling grades. So there's been research coming out about gold mining grades. I mean, they've fallen a lot. The last you've been in the mine investing in commodities and mine companies for years. I mean, grades have just collapsed over the last 20, 30 years.
Gold mines and copper mines. Yeah.
Well, I think there's good opportunities there for the royalty companies to come in and fill that niche. And then the other beautiful part of the royalty business is you don't have to worry about the cost going up because their costs are fixed for the most part.
Right. Now, let's not forget, a lot of the larger companies like Franco, Royal, Gold, Wheaton, Precious, in the last few years, they have done a lot of streams. And so streams are where you give the company money to develop it, and in return, you have the right to buy a certain amount of a commodity, gold or silver, at a reduced price. The original streams were frequently done at a fixed price. So you'd say, okay, we can buy 20% of your silver production and we'll pay you $5 an ounce. More and more you see they're done at a percentage. So it might be 25% of the spot price. And so those costs will go up, but it's still a great business. But I just want to make sure people.
Yeah, the costs are only going up a little bit though. So if the miner has a problem at one of the mines where the cost at the mine goes up 30 or 40%, say there's like a labor strike, or they have problems with electricity, or there's just an unforeseen construction cost at the mine, say they need to replace a bunch of the property, plant, equipment. I mean, the royalty company still doesn't have to deal with that for the most part, though. They're not on the hook for those CapEx bills.
100%, and that is the beauty of a royalty model, which I love, by the way. I love, and a lot of people think royalty companies are expensive and they don't have any leverage, but nothing could be further than the truth. They have plenty of leverage.
Well, the industry, I wanted to actually discuss this before we stop recording. I mean, the industry seems to think they're relatively cheap because look at all the consolidation the last 12 months. There's only a couple small and medium-sized companies left in the precious metal royalty space. I think just Cisco Gold Royalty and EMX and Vox, pretty much everyone else has been either merger or acquisition recently.
Yeah, I mean, there's a few more than that, but yeah, no, I mean, there's a part of that. Part of that is a reflection of what you say, and part of it is a reflection that for a royalty company in particular, size really does matter. You look at a company like Franco-Nevada, which is the largest. They've got something like 40 producing assets right now. So they're pretty well diversified in terms of jurisdiction, in terms of mines, in terms of the mining companies that they have royalties on their mines. They're pretty well diversified. Their largest royalty is 15% of their NAV. With a smaller, so that reduces your risk, obviously, and it also reduces your cost of capital tremendously. But the smaller mining companies might only have 3 producing mines. And so if something goes wrong on one of those, obviously that has a much more significant impact on the company. And so size truly matters for these royalty companies. And that's why there's been not only acquisitions, but there's also been mergers. And more companies are trying to get together to build bigger companies, at least mid-sized companies, to bring your cost of capital down and diversify your risk. Yeah.
The business model, for it to work properly, there needs to be a certain amount of scale and diversification, because then you have a good amount of cash flow and good amount of diversification, and then your cost of capital goes down. And then if you have a couple royalties or streams offline, the business is not in any jeopardy of bankruptcy or anything like that.
Absolutely. But I mean, I've talked about some of the risks, if you like, or of setting, but I'm a huge fan of the royalty model. Huge fan.
And it's better than getting a loan from a bank that could take like 12, 18 months. There's all these rules, regulations where the bank's not flexible at all. So like these royalty and streaming, the terms can be restructured. You can restructure these things. The banks are not flexible like that.
No, absolutely. Well, you're seeing that also with another one of my favorite sectors, which are the business development companies. They're not royalty. They're not in the mining business, but business development companies that make loans to small businesses. And what you've seen over the last 10 years, but particularly the last few years, is more and more larger, profitable companies are coming to BDCs to get loans, because the banks are, as you say, the banks are proving so inflexible and take time. A BDC, if you go to a BDC and the BDC you're already a customer of the BDC can lend you money within a matter of a few weeks. Banks take forever to do new loans.
If you get approved at all, yeah. I mean, like for a small business loan nowadays, like you have to pledge your house as collateral. It's ridiculous here in the United States.
Yeah, no, absolutely. And that's why even bigger companies are turning to these BDCs for their loans.
Well, I don't know if you want to name company names or you have a newsletter to promote in addition to your money management business.
Well, people can go to the website, which is adrianday.com, www.adrianday.com. And on that, you'll see one side you go to the newsletter, one side you go to the money management. So that's the easiest way of saying it. So I do have a newsletter that's unrelated to the money management business. And then I have obviously the money management, which is
I actually found you through Agora Financial for many years. So you've been writing Austrian School Economics and Commodities newsletters for a very long time.
Yeah. Thank you.
Well, I really enjoyed our discussion today, Adrian. We've been talking for over an hour. I feel like I could talk to you for another couple hours, so we'll have to have you back on again soon.
Sure, absolutely. And I really appreciate it. It was an interesting conversation.
Well, have a great weekend down in Puerto Rico. I wish I was down there.
Well, thank you.